video to try and make people stop panicking. Just try to tie together some of the things that we've covered so far in Chapter 1. Excuse me. Okay, so we start off accounting. What's accounting? It's just a financial information system. We're taking all the checks that you write, all of the business transactions, and we have to say, okay, we identify what goes with this business, what doesn't, and then we're going to record the information and communicate it. So financial accounting or accounting is just a financial information system. We do these three things with the information. Once we get the financial information, what are we doing it for? It's going to be used by two basic groups of people. The internal users, this is the management, any employees, anyone who is within the company itself, the entity itself. And that's generally managerial accounting, a course that you'll have to take later on if you're business majors. So then we have external users, and these are people who might want to buy stock in the company. They could be people who might want to lend the company money. Just basically anybody outside the company. Labor unions, the government, regulatory agencies, all of that. The internal users and managerial accounting, they use a lot of internal reports that you'll get into in managerial. What we will be doing in this course, we are financial accounting. This is the course you signed up for. And financial reporting organizes all of this financial information, and it communicates it using the income statement, the balance sheet, retained earnings statement, statement of cash flows. These are for external reporting. Okay, so these statements, since they're for external reporting, people want to be assured that what they're looking at is real and is comprehensible and somewhat comparable one company to another. So when you go into a bank and want to get a loan, they don't want to look at some format for a financial statement that you've made up all on your own. They want to see a standard financial statement, and that's all these are. So the statements are prepared according to GAAP, Generally Accepted Accounting Principles. So these are kind of the general principles. They're not laws of nature. They are generally accepted in the business community of how we prepare the financial statements, what information goes on them, at what amount we report that information, all that good stuff. Generally Accepted Accounting Principles. Who comes up with all of these things? Right now, it's FASB, Financial Accounting Standards Board, and the International Accounting Standards Board. They're the ones that are kind of the rule makers. They come up with the rules, and it's not a totally clean process, but we don't get into that now. Generally, the enforcers, and there's some overlap here, they come up with their own rules too, but generally enforcing a lot of the generally accepted accounting principles are the Securities and Exchange Commission and the PCAOB, Public Company Accounting Oversight Board. In general, your audited financial statements have to be prepared by a certified public accountant, CPA. I'm one of those. And part of being an accountant is making sure that you have very good training on ethics, because ethics is fundamental to having people believe that the financial statements really reflect what's going on in the company, and they're not just something that somebody made up. Okay, so that's that part of it. Just going back over here a little bit, just to get into a little more detail, what info are we going to identify, record, and communicate? Well, here's where a couple of assumptions we make come in. We're going to assume that we're only going to record, identify, record, and communicate things that go with our company. So we have to be able to separate our company from other companies. So we should be able to draw a circle around the company that we are keeping records for. And we only record the transactions that pertain to that company. The owner's finances are kept separate. Everybody else's finances are kept separate. So economic entity assumption, it is this company or entity that we're recording the transactions for and that we will report on. Monetary unit assumption, that tells us what information can go on these reports, and it's going to be things that we can measure in money terms. We can't measure that the president is a nice guy or the treasurer's a really smart lady, all this stuff. Monetary unit assumption, how much do we pay these people? How much did we sell? All that good stuff. It has to be measurable in dollar terms, monetary unit assumption. Okay, a little bit more on the economic entity. The book goes into types of economic entities. And it is important that you know the pluses and minuses for each one, especially if you're ever planning on going into business for yourself. You need to know the various characteristics. For instance, the corporation, one of the big ones is limited liability. That means that if someone slips on a banana peel in front of your store and you are incorporated, they can come and take away the store, but they can't come after your car, they can't come after your house, they can't take your personal stuff. Same thing happened to a proprietorship. They have basically unlimited liability. So same banana peel, same injury, they could come and take your house. And partnerships, they're also generally have the unlimited liability. So the other good thing about corporations is their ability to raise funds, because they, unlike either of the other two forms, can sell stock. So people can buy shares in their company and they can raise large amounts of money. Proprietorships and partnerships, if they want more money, they generally have to go to the bank or to other creditors. Okay, so I'm going to leave it to you to, just make sure you have all of those characteristics down. The other thing to keep in mind is that corporations, unlike the other two, are a separate legal entity as well as a separate economic entity. All three are separate economic entities. In other words, you got the company here and the owners here. Proprietorships and partnerships, though, are not separate legal entities. They don't have their own tax ID number, and they file their tax returns through the owner's, taxes on the owner's tax return. Corporations they have their own ID number and file their own taxes separate from the owners of the company. So all are separate economic entities, but only the corporation is a separate legal entity. So that's kind of an overview of the first part of the chapter. I hope that helps tie it together a little better.